Morning.
Hello, everybody.
Morning.
How's everyone doing?
Good.
Good.
Make it.
Love it.
For the next 2 weeks, I'm here and I'm excited.
Oh, good. That's good. And I'm talking to you shortly anyways, so.
Yes, lots to catch up on.
Danielle, where were you bopping around to?
I was in Cape Breton. I took a break and I went up north because Atlantic Canada is pretty open right now, so we can travel.
Oh, great. Cool.
And I heard film production was shutting down in Vancouver.
Yeah.
That
Spiking in the West Coast
in the West
and in Ontario as well. But the Atlantic bubble has a 2-week quarantine. So we've got almost no COVID out here.
Fantastic.
Crossing fingers.
Fantastic.
I know,
Yeah.
knock on wood. Why did I say that?
No, it's good. It's good.
Yeah.
It's good.
Yeah, it's
You're
good.
celebrating it.
So
I'm from Newfoundland. So
Oh, amazing.
I'm from that area, and my heritage is, my grandmother grew up there and stuff like that. Anyway,
I'll talk to you later
get
about
started.
that.
Okay.
I want to go to Newfoundland.
It's beautiful.
all right, guys. So I'm really, really sorry to say this, but my computer just crashed this morning. And just 10 minutes before this, I was panicking, and Kate and I were talking about it. So I don't have a presentation here. So Kate and I feel that we can talk, and I can take you through the 4 valuation methods. But Kate and I are wondering if we can keep today's session to an hour and actually split it up. So we'll go through the 4 valuation methods, and I can give you examples of, different valuation. And then maybe we can either have a totally new session added just so that you guys can go through the venture math exercise, or we can use one of the office hours, or we can shorten one of the sessions and like branding session or a portfolio strategy session, and do this. So let me know what is your preference.
Yeah, and actually, if you want to pop in the chat, which is your preference. We wanted to be really cognizant of your calendars too, but also make sure you got this. So if you want to pop into chat, I can actually just log, which is easiest. And again, we're talking about keeping the exact same time slots, and Jags and I will make up the time for you, or adding an additional hour. We can decide when that is, and it will be recorded regardless, or using the office hours this week, which is 3 to 4 Eastern on Friday. So just pop in your preference into chat. You can DM it or make it public, and I'll log that.
And I am sincerely sorry. I was working on making some changes, and I did not send that to Kate. In hindsight, I should have sent it to Kate last night, but I took my Mac for granted. It is 10 years old. It took me, this far, and I've been resisting buying a new Mac because they don't have the USB port and all that stuff. It's such a clean design, and I love my USB and HDMI things. Anyways, so I sincerely apologize for the disruption, and I hope you will get the same value from today's session. And plus, we will not do anything because of this. We'll just do it at another time. That's what I'm trying to say. Thank you for your flexibility. I really, really sorry. I can't see anybody except but you guys can see me, right? Oh, now I can see everybody. I'm actually never used Zoom on my phone, so now I can see everybody now, or most of the people. All right, so having said that, I really want to take a deep breath because I was freaking out. And I think I was like bombarding Kate with messages when she was in another meeting. So I'm just going to breathe a little. And thank you for the Friday's office hour. Carol and Joan were there, really had an amazing time talking to them. And more, I'm realizing that there are so many pockets of people, not only women, who are interested in diversifying their portfolio and are considering angel investment as part of their portfolio. So would love to understand more how you want to affect the community you're in, and how can we empower you to go out to the community and start doing syndicates for the companies that you are passionate about. So we are also creating a syndicate in a box model, Kate and I. So we are happy to help you with that as well beyond this session. So today's session, first of all, did you guys have any questions from last session? Because I know it was, we were looking at the little bit of venture myth, the dilution, the financial statements, and what are the important statements, and how do you actually ask them from an early stage entrepreneur, right? Because most of the entrepreneurs or most of the people in the early stage are pre-revenue and sometimes even don't have they're still working on their first MVP. So any questions around that you want to talk about your portfolio company? By the way, Jennifer, did you look at your your husband's investment, the term sheet? You muted.
Sorry. No, I did not. I have that on my list.
I was thinking about you.
I know. Can I just say one thing? I'm sorry.
Yes.
It's just if I don't say it. So after our meeting Thursday, so I'm in the process of selling my company to a
Okay.
private equity company, and they just came back. We're like on the 5-yard line. We're supposed to close in 2 weeks, and they're trying to change the valuation on me.
So
So
is it a lot?
I'm super anxious to hear the valuation models. So yeah, I got pretty distracted by like figuring out how to respond to all of this.
Sure. No, I understand.
Jennifer, did they state why?
Because when we started, I said that I never could give a date, because with long lead sales, you cannot do that. But I was like, we're going to close Disney. It's going to be both motion picture and television, and eventually Lucas, Pixar, Marvel, Fox, the whole thing. And we're still not closed. We just finished our security assessment review on Friday, but we're still a long way from closing. And they're like, well, that deal's not closed. And we had counted that in the valuation. And I can't control how fast it goes.
Right. So here is my 2 cents. Obviously, I've never been, I have not sold a company. I've been an entrepreneur, but so this, take it with a grain of salt. However, I have helped founder negotiate. You can say, it depends on what the delta is, right? If it's a huge delta, right? And it seems like with this big contracts, there may be a delta might be significant for you as an entrepreneur. You can say, you can put it in the negotiation that if it closes, you can say that valuation that you're presenting is based on 3 conditions. One is that if it closes, I want to get the delta that we talked about at that time. And if and also second is what can you do to help me close this, right? Ask for their help. Like if they put their network behind you, would it help you to close earlier and put it in front of them, or connect them to Disney or whoever your lead is there, to say, no, we are 90% there, or the probability is high. So so make it like a 2-step acquisition if you're still interested in, it seems like you're in the last mile, so maybe you are. And then the third thing is that you just delay it. Say, okay, I have a lot of confidence in what I'm doing, and I feel that it is going to close. I'm not willing to negotiate, but we can continue this relationship and come back to it in a month from now. And when you kind of step back and give that confidence, they will say, okay, she has an upper hand now. Right now, they have an upper hand because they're saying, we don't know what if it's going to go through or not. So if you're okay with it, and if you think you deserve, which I think you do deserve, you want to get that valuation, then step back and say, I understand, let's not play catch up, catch each other, whatever, chase each other. Let's come back to it.
I appreciate that. Yeah. And I don't want to get in the weeds of my thing for the class, but we already went down that road. They offered me X plus a earnout over 18 months if I close various deals. And we settled on, I can't control on when those happen. So let's do the sale now. I did ask, could I do it a year from now? They said, no, they want to buy it now because they want to integrate it with their other products. So we're in this kind of just thing. I think the main thing that I want to learn from this morning, aside from the general information, is just how do I even ascertain what that delta is? Like I know what the subscription price is going to be, but the lifetime value of it, the possible expansion of it.
Are you
I would-
retaining any stock in your company?
No.
Okay. All right. So I think the model that you would be most interested in, the VC method, which is very close to PE method. So there are three tiers. The private equity tier, which they look to turn the company around in 3 to 5 years, and then they want at least 5 to 7x their, sometimes 3 to 5. So in that range, the return on their investment. The VC is, looking for 10x. The angels are looking for 20 plus X, right? So that's why the private equity might, I don't have that much experience with private equity, but I think the VC method is the most aligned with you. And what they look at is that what your revenue, we'll go through it. Why don't we start
I don't
with
want
that?
to, take the order. Just do the class.
No, but it's great, right? I mean, you're in
Well,
it, right?
this is actually perfect. Yeah.
Yeah.
And
yeah.
Jags,
So-
I was going to say, this begs the question, for all of us as well, is how much of, future value do you pay for now? And that, not just for Jennifer's company, but this is applicable across any deal that we're looking at. Because
and
generally
from an investor.
you're paying, a lot of the valuation is built into what the potential is,
Right.
versus what has been closed already. If
Yeah.
Jennifer closed the Disney deal already, she could probably command a much higher valuation. So it's sort of chicken or egg.
Right. And from an investor perspective, right, how much of the future value you put into valuation is a billion trillion dollar question, right? And we don't have that crystal ball, but all we can do is look at all of our experiences collectively, and also going back to our thesis and saying that, does this, from an investor perspective, do I believe that it has future? So if I were to invest in another car brand, which has no EV built into it, I'm like, okay, why would I even, because there is no future value. But if there is an EV car manufacturer who is like, for example, NIO, which is a publicly traded company, why NIO is doing also as well as Tesla or great in Chinese market, because even though it's an EV market, they have a different model, right? They have a battery swap model instead of charging. So as Tesla, you go and you charge. NIO, you just go to a station, they swap your battery, and off you go. So is that something that I believe in? So it's also depends, going back to your thesis, going back to like, do I see future with this, right? And based on that, you actually evaluate the company. But again, as I said, going back to your thesis is the most important thing you can do over and over and over again. So let's get started.
Could
We're
I, could
gonna
I just chime in really quickly? Or
Sure.
I think Jennifer's case is actually really indicative, and I love, thank you for bringing it up and sharing,
Yes.
frankly, a vulnerable situation. I think especially as a founder or as someone who's, I think probably all of us have been at a negotiating table where you think you're about to like close it or you're just about to sign it, and then, or there's a power play. I don't know if this is the case, but they're like, actually,
we can't hear you,
this
Jennifer.
thing. Oh, Jennifer, I don't
think
know.
she
if-
Just
said
shaking my
something.
head. It's absolutely a power play.
It's a power play, and to undercut what was concrete. This is something I've seen again and again at negotiating, when you think you're in the final mile and then they say, well, actually this other thing, are you as good? And this happens to female founders more than male founders. So
Absolutely.
I think just remembering that it's a power play and they want to acquire you and they think there's huge value. So I agree with Jags and saying, like, you the power is still in your hands. The power is still totally in your hands.
Yep.
Thank
You
you.
Because
wanna look at-
they need you to close
They
that
do.
deal.
They-
They do.
They can bring nothing. The second option of them coming to help brings nothing.
Okay.
But I didn't want to go down that gender thing, but it's like 5 white guys and me.
Yes,
No,
you can go
it is
down the
that
gender
too.
thing, because if it's
Yeah.
a reality, you should know what you're up against.
Yeah. So, and Jennifer,
I know,
think
I
like,
know.
think, Jennifer, one thing I often think about is in 10 years down the road, is this going to bother you that you sold your company because, and you didn't put the due diligence? You worked really, really hard. Can you afford to step back and say, nope, I want what I want?
I can't afford that. I can.
Okay. So I'm not saying you should do that,
Right.
because but at the same time, you have to say, okay, if this company is interested in it and they're pushing me, there are others, and everybody wants Disney and Lucas and stuff. So hey, I would really think the ball is in your court. Don't let them intimidate you. Don't let them overwhelm you. And if you have some time today, and this goes for everybody, but I think you need probably a little bit more, get this audiobook, Never Split the Difference by Chris Voss. Okay. And listen to it and figure out, he gives a lot of examples on how do you communicate when you are negotiating.
That is funny.
Like,
Thank you.
Power through that book. And I really highly recommend it for everybody. But so stand tall, we are behind you, even though we can't help you, and you stand in your power. That's my
Well,
tagline.
this helps. So thank you, everybody. And thank you for all the encouragement. Okay.
Absolutely.
Do the
That's
clap.
what we are here for, right? Each other. All right. So let's go through the 4 methods. The first one is the weighted method. So the weighted method is the 7 things we talked about when you're looking at the company: the problem, the solution, what differentiates them, the competition, the revenue model, their team, and their financial past and future, right? So these are the 7 things. So what I was, on the slide, what it shows is, and it's based on the most important criteria, not for the ultimate outcome, but until the next milestone. So if you are in an early stage, right, you are considering investing in this company at an early stage, and in 18 months down the road, they have a Series A coming up. So in order for them to be successful from now until the 18 months down the road, when they are actually raising the money, what is the most important criteria? And these 7 things has to be equal to 100%. So for example, if let's say I take an example of Heirloom, right? You may have gotten a chance to take a look at that deck. So if I look at Heirloom, the market size is my number 1 priority. If they can capture, or if they can prove that there is a market for this, I'm going to, attach certain value to them. So for Heirloom, the priority, the first three things priority is the market size, the team, and the revenue model, right? So market size and revenue model kind of go hand in hand. So their revenues, they said after soft launching in 4 months, they were at $65,000. Then they developed the technology and then they went up to $100,000 the last 4 months. So you know that there is a revenue. People are willing to pay for this. So then I would attach in a weighted model, what is the most important, based on my thesis and based on what I would like out of this at this early stage. So I would say, in this case, the market size, I'd probably put 30 to 40% weighted. And then the revenue model, 20%. Anything over 20% is pretty significant. Team, I know that the team is pretty good. I don't have doubts about team that, they need to do XYZ until the next round. And then I total them up and I give them the score, right? And then I multiply that weight times the score, and whatever I come up with, average value, and what is the average value in this industry, and then the valuation I multiply the total by. Does that make sense? Right? So if
I
it's
get the percentages, but what are you multiplying it by?
Oh, the score. So the score is, this is the most important. So it goes from 0 to 1. So my top one is, like, for example, market size. I'm going to multiply that by the entire weighted weight, because I really believe in that. So, right. So I want to transfer the 30% directly over. I don't want to take a fraction of that. Do you know what I'm saying? So weight times the score and the factor, and then I average all 7 of them, and multiply that by what is the average valuation in this industry for this early stage. That's where you need to Google, you need to read PitchBook and CB Insights, whatever it is, to say what are the competition for this particular thing. Go to Crunchbase and say Crunchbase company XYZ, and then they tell you how much money they have raised and what their valuation, whatever it is, right? And then you also look at what companies are acquired in this, and then you take an average, right? And you take that average valuation and you multiply that by the total score that you came up with. This is in a case that you do, so that this is if it matches your thesis and you do have some conviction toward why this company is going to do what it's going to do 18 months from now. So as an early stage investor, we don't look at Series E or acquisition, right? I mean, that's our goal. But we want to see, can they do what they tell me that they're going to do until the next raise, right? And then what will it take for them to go from point A, which is now, to point B? And from that 7 criteria, I come up with this number. Any questions there?
Jags, just clarifying, is the 7, those are your 7?
These are my
idea, 7. Yep. So the idea is to be picking those priority areas that you think are the most important, and then pumping it into this weighted average model.
Right. These are mine. But if you don't look at this 7 area as an early stage investor, you're missing out. You need to minimally look at them, whether you count them in your weighted formula or not. That's entirely up to you. But you should have a pretty good idea about these 7 things.
And do you have a spreadsheet, Jags, or how do you compare deals? I'm a researcher, I have a PhD. This is, I'm sure other people in this room have models.
You can
as well.
help us with that, Joan.
Okay, well, I'm just curious, because literally I would run, when I do competitive analyses, I run what my heart says versus what the numbers say, and kind of do a gut check about that. Because sometimes I'm like, ooh, but there's something special about this team, or there's something like I need to learn more, or like I don't know the vertical. That's a big question mark. But Jags, do you have, or I'll start making a spreadsheet, I guess. I'll do that on the side here.
So
if there's no spreadsheet.
One thing you should know about me, Joan.
Yeah.
I'm not good at spreadsheets.
Well, welcome. I am.
So I would love all the help you can get. But however, having said that, this is a pretty, multiply whatever. So this is what I have is, I have this master spreadsheet for all my investments, right? And I actually don't have a spreadsheet on how I calculate, but I calculate and put this number, the final number in it. And you bring a very good point, the gut check, or this is something special about this team. There's always going to be something special about every team, right? So going back to your thesis, this is, do I believe in this company? Do I believe that the founders have everything that they need in order to be successful? And remember these two things. You will know 50% what's going on behind the scene after you invest, right? And most of them is like, why didn't you tell me that before? Well, you never asked, right? Founders are also being trained, just like we are being trained, right? So I say, okay, so found 50% of everything you're going to know is after you invest. And then the second thing, one of my mentor told me this, that every time you want to invest in any company, find out all the reasons why you should not invest in this company. If you can find zero reasons, then you move to the next stage. What we do as investor is we find all the reasons why we should invest in this company. So I'm asking you to first do that. It matches my thesis, blah, 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 right? Second is, okay, can I find any reasons why I should not invest in this company? Like really, really dig deep, right? This is the area that I also have to improve because I also get emotionally, engaged, and I feel like, oh, it matches, right? So I'm not there yet, but this is something else that I was told by my mentor, that find all the reasons why you should not invest in a company. All right. Any other question?
Yeah, and
this
just
goes,
Joan, just to answer your
sorry.
Yeah, Joan, just to answer your question, there are absolutely people that have full spreadsheets on this, and there are, if not like full algorithms where they're taking, multiple different feature sets into this calculation. Funds as well have their own internal, just like crank the numbers. Is this on paper taking emotion out of it? Is this a good deal? And so, and many will then also line up, like if it's a multi-decision layer and you've got 3 partners, they'll actually do it then separately and then combine. And then you can get, if you want to, you can get statistical as you want on these things. And then I would just, and you would do this anyways because you're a researcher, is just then be actually tracking the success. That's one of the key things, is to make sure, you know this, that's to do with algorithms, it's to do with all this, is you make sure that actually the results are working. But yes, you let that brain go on a statistical model on this.
Yeah. Another thing I want to mention, what Kate said is absolutely available outside, and a lot of people do it. However, I find that a lot of the data is not available yet for early stage companies. So everything that this, looking at a lot of the numbers and stuff, it becomes extremely important if you are investing in Series A, B, or later. Early stage companies, what I have experienced is that most of the investments are done because we believe in it's made more from our gut, at least what I'm trying to say is that it's made more because we believe in the founder, we believe in the future value. Like Christina said, we believe in the future value at the present time, right? And a lot of the data may not be available. But having said that, there is more and more data available even for early stage companies. So you should definitely do this if you can.
Yeah. And Jags, I actually have a good math example just about of what you're saying. Is I do know of a firm that had 3 partner decisions, so each partner got an equal score, but they also used scorecards in there. It was a simple scorecard, 5, each partner got 5 points based on a couple of these key areas, right? So you have to score. So if anybody got below a 3, they automatically threw out the deal. And then anything above that, they would basically make group decisions. However, when they went back and they looked at the success rate a couple of years later, what they realized is that even if you had a situation where 3, maybe you had a total of 16, but it was kind of like a lukewarm, maybe most people had 3 to 4, or I guess that would be 4 to 4. Forget the numbers. And then you had another company that scored in total the exact same amount, but one partner was emphatically supportive of this company. Every single instance of the success rate, they had one partner who just really believed in that future value. And so it came out in their scorecards. But again, if you line it up on the exact same score without that like emotional, emphatic buy-in, they actually saw there was a lower success rate. So it's like very interesting how you can think about combining these things. And then, yeah. So anyways, I wanted to just give that a
No, that was great, Kate. Do you think we can get an example of those 3, the scoring card that they use just to learn from it?
I didn't have my hand. It's a little bit of an anecdotal, and I apologize. I know that it was a very simple, almost based on your exact buckets. It's like market size, team, and then each one got a score, and then they combined the scores. So it was again, it was a simple scorecard. But yeah, so I don't think it would be valuable. And I didn't see it. This was a very,
I've been a judge for hackathon, and that sounds exactly what we do, like to a T.
Yep.
Yeah.
Yep.
All right. So now the second one we are going to go through is, so we covered the weighted example, right? And no questions there. I mean, we covered the questions there. The second one is going to be the dilution method. So what is the dilution method, right? So the dilution method is that how much of the company they are giving away in order to raise sorry, 1 second, hold on 1 second. I'm not able to see you guys. Why is that? Okay. Okay. Can you guys see me? My cell phone coverage is not great here either. Okay. So the dilution method is based on what percentage is given away in this round, right? So we talked about that most of the rounds, they raise about between 15 and 25%. The average is about 20% of the valuation that they're raising in every round. So if we look at an example of the dilution method, what you want to do is that you are raising this round. You want to find out what the burn rate is for the next 18 months, the average burn rate. And then you take that burn rate and you compare it with the money raised, and you come up with the post money and pre-money. So let's do an example. So let's say the burn rate is about, $55,000 a month now on average, right? So for the 18 months. So you take that 55,000 or 50,000, whatever it is, times 18 months, right? Because even though they may start raising for the next round 12 months in it, you want to make sure while they're raising, they're not running out of the money, because people are going to ask, how much money do you have left in the bank? Investors can ask and should ask all sorts of money related questions. That's also another thing I find that, not to talk a lot about gender, but to mention that women are always shy of asking those questions. How much money do you have left in the bank? How much are you getting paid? Show me your cash flow, whatever it is, right? So feel free to ask those questions. So let's go back. 50 to 55,000 burn rate. You multiply it by 18 months. So it's about $1 million, I think. And assuming the 1%, $1 million they need is 20% of the valuation. So that brings you to pre-money of 4 million and post-money of 5 million. Remember how we look at the percentage is the post-money divided by the pre-money plus the raise. So the post-money is 5 million. That makes 1 million, 20% of the total raise, and the pre-money is 4 million. So your valuation pre-money is 4 million, post-money is 5 million. Everybody understood that? So you take the burn rate times 18 months, you come up with a number, and if that number is the 20% of the total valuation, that valuation is post-money. Got it? Any questions? All right, silence means no questions. Okay. Now we'll come to the VC way. How do VC, and that's where I think, Jennifer, you might be interested in this. They look at the acquisition price and what is the desired return multiple, right? So then they look at the entire math example based on these two criteria. So let's say that the current raise is $1 million and revenue in year 5, because this is a long game for the VC, right? They're coming in at Series A. They want to know what the revenue is going to be in year 5. And the founder says, I'm going to make $40 million revenue in year 5. The VC says, great. I'm going to divide that into 2 because I know that you're very optimistic and I'm very pessimistic. So revenue that the VCs count is $20 million. They immediately divide that 40 million into 2, right? And this is just a rough formula, but this is actually a very quick way for VCs to see if it's something that they want to get into. At the acquisition, they want desired investor return to be 10x. That's their magic number, right? All the VCs. So they look at the revenue multiple in year 5 is going to be about $20 million. I mean, sorry, no, wait, I'm not doing this by spreadsheet, so give me a second. So the current raise is 1 million. Revenue, the year 5, founder thinks is 40 million. Revenue in year 5, investor thinks it's 20 million. Oh, and the revenue multiples, obviously. So the industry that they are in, what can be the acquisition price for that in the industry? What is that revenue multiple? So let's say that the SaaS company, the average multiple for SaaS company is, probably 10, right? Between 7 and 10. But let's say this is, not a SaaS company, it's a CPG company or whatever it is. So revenue multiple is going to be 2. Let's just pick 2. So you take the revenue in year 5 that the investor said that you're going to make, which is 20 million, you multiply that by 2, because that's the average acquisition in your industry, the revenue multiple, you come to $40 million. I want, as a VC, I want 10x my money. That makes it to acquisition price of $400 million, right? So in order for me to make $400 million acquisition price, I need to make sure I have $40 million revenue. So the required pre-money right now, and then I divide it by 10 again, because 10x was one thing, my multiple, I divide that again, and I come to $4 million post money. minus $1 million raise that I'm doing, which is 3 million. So that is the valuation that I am interested in investing at. That's how they work backwards. I know there was a lot of math here. So, okay, do you guys want to go through it again? And it doesn't help without a slide. I apologize. Okay, you said something? I can't see the chat. I think Kate said something. Okay.
I
Go-
just got
I can't-
confused because I felt like it switched from a 2x multiple in the example to 10x.
No. So 2x revenue multiple. So what do the companies in this particular industry get acquired for? That's the revenue multiple.
Right.
My desired multiple as a VC is 10x.
Okay. Okay. So, all right. Can I just walk?
Yeah, please.
Maybe Joan should do this. Okay. So the founder said they were going to make 40 million in year 5. The investor dilutes that by half, saying, you know, whatever, it's only 20 million.
Mm-hmm.
And since it's a CPG, you say it's times 2.
I just used 2 because the
I don't know.
simplicity
I
of
don't know.
it.
I feel
Yeah.
like.
It's is the cutting in half, is that just like is that a guesstimate of what you've seen, or is that what actually happens, or is it just, I'm confused on that.
Yeah, sure. So VCs are pessimistic in creature because they have lost so much. Most of their deals go under, right? So they say that, and founders are by nature very optimistic. So they said, okay, based on today's revenue, I feel that in year 5, I'm going to do 40 million. So for a quick example, VCs most of the time divide that in half for that reason only. And I've seen that VCs use this as a quick mathematical mind thing to see, am I even interested in looking further into this company. And the reason I presented it here is because as angel investors, if we do that too, not necessarily cut it in half, but remember, founders are always optimistic. I'm okay if they do 40 million. I'm great. Because I got the company really cheap. If I had calculated at what founders said, my valuation would be a lot higher. Am I answering your question, Christina?
Yeah, I mean, conceptually, I get that, founders are usually rose-colored glasses in terms of their ability to capture market share. I just wasn't sure if that is an approach that like we should take without having sort of any data to back that up, and how that differs across a software company versus, like something like, what
CPG company.
Yeah, different industries and whatnot.
I do that because it's in my advantage as an investor. Like, remember, if I have doubt that the founder is not going to make the revenue, even if I don't have doubt, 5 years, who knew COVID could hit and a lot of things can happen, right? So as an investor, you really want to be pessimistic, not to a point that you're going to kill the founder. And this is your valuation. Doesn't mean that you're actually investing at this value. All you're saying is that this is what I think the company is worth it. Then you go to the negotiation table and say, okay, Mr. Founder, tell me, why are you worth more than this? And if revenue is the only factor, then I want to know more. What if you don't meet the revenue? What are your risk mitigation plans? Sorry, Kate, go ahead.
No, that's okay. And Christina, I think qualitatively speaking, this process is one that pretty much every investor goes through, is pretty much every investor looks at a founder's projections and says, okay, they're probably being optimistic. It's kind of to what varying degree you want to look at that. Some look at it individually. They might look at a particular deal. They might look at the 3-5 year projections and say, gosh, that seems really aggressive. This looks like maybe it'll be a half. Or some people just flash across the board. I think Jags is using, that's a little bit more of a hypothetical, is the slash it in two. But very much so, investors will almost categorically assume, and again, to their advantage.
Mhm.
And ideally, then you do some negotiations and come in the middle and all that good stuff. And some are more founder friendly, some are totally predatory when they go through these calculations. But yeah, I would say that there's usually some gap that you'd want to at least think about.
Yeah.
As an
Yeah.
investor.
And I'm not saying, because it's not in your benefit at all to have this predatory relationship with a founder that you're interested in investing in, right? This is a quick check, math check for you saying, is this, and a lot of times if you are a lead investor, if you're leading the round, you're putting a lot of the money in it. You really want to make sure that if you're coming up with a term sheet, you have all the answers for the follow investors, right? The fellow investors that you're going to attract. So you really want to make sure that you have the conviction after the revenue numbers. And as a VC goes, they look at numbers. They look at revenue more than any other, criteria. Having said that, if this is a really hot company, founder can say, great, Miss Investor, thank you for your time. I'm going to pass on you because you are just not believing in me, right? So this is just the first step. Going back to, I think it was Jennifer who said, I lost her by multiplying by 10. So let's go through this example one more time, all right? Maybe that would be helpful. So let's say the current raise is 1 million. And we're looking at the revenue. Founder says, I'm going to make $40 million revenue in year 5. And the investor says, great, I'm going to cut it in half, $20 million. And I know the companies in your industry get acquired, around 2 revenue multiples. So 20 million times 2 is $40 million, right? So your acquisition value is about $40 million. I want a desired investor return to be 10. So in order for me to get 10x return in 5 years, I am going to divide the acquisition value by 10. So 40 million divided by 10 is 4 million. If you are looking at acquisition value right now as 4 million and you're raising 1 million, your post money is 4 million, my pre-money is 3 million. So if I give 25% of the company, that equals to 1 million. And so that's what I'm raising at this time, Mr. VC. Or VC will tell investor that I am interested in acquiring 25% of the company. I'll give you $1 million. The post money has to be 4 million, and obviously pre-money is 3 million. Was that helpful? Jennifer, was that helpful for you?
Yeah. I'm really good at math. I'm just trying to get exactly your thing. Is there any way, can I just share this? Is that okay?
Yeah.
Okay, so what am I missing here? So in your
Okay.
example, okay, go
Okay,
ahead.
so the first line you say, how much are you raising? Current raise, which is 1 million. Line one. You write before year 5 founder.
Okay, sorry.
So in B6, that should be 1 million, what I'm raising.
The current raise. I can't, my phone is so small. What I'm raising right now is 1 million.
So B6 or B8 now should be 1 million, Jennifer.
Okay,
Okay. So what I'm raising is 1 million. founder says 40 million, year 5 is 20 million, divide by 2. Revenue multiple, right? Revenue multiple is 40,000 because I'm taking the 20 million revenue and multiplying by 2,
Mhm,
right? So
mhm.
that should be, so that's 40 million. I want 10x return. So 40 million divided by 10. So my desired return is 10 in 5 years. So the current value is 40 million, which is the future value, divided by desired return, which is 10.
Okay. That's not gonna work.
So no,
No.
desired return is 10. So you want to write down there where you have desired return is the current value post money. That's what you want to write down. So the post money is equal to year 5 acquisition value, which is 20 million times 2, divide by 10.
Which is 4 million.
So that's
Right.
not the, that's
20
the
million
post money,
divided times 2 is that. Divided by 10 is that.
right? So that is the post money valuation for this raise.
Okay.
But that's not necessarily what she's investing. And so the 10x, I think, if I'm following right, Jennifer, the 10x return is just the multiple. So regardless of whether Jags is that, regardless of whether I'm like putting in 5,000 or 10,000 or $100,000 check, you're saying that you're thinking of the return in a multiple versus the absolute dollar amount. Is that right?
So the VCs always wanted 10x. So right, so that's the number I used. They desired 10x. So the post money is 4 million. So the pre-money is post money minus current raise, which is 1 million, which is 3 million, right? So pre-money is 3 million.
Basically, I just, to clarify my own mind, but to maybe help others, is this shows you that the VCs are pushing down the valuation to 3 million.
Absolutely.
Whereas in our dilution method, it was more like a $4 million valuation or 5 million post. This, because of the way they're diluting it and basically saying, I don't believe in your revenue model, it's pushing it down.
So in the dilution method, remember, we took the burn rate times 18 months. That's how we said we are raising $1 million. That's how we came up with post money and pre-money. So if the founder agrees that, okay, Ms. Visi, you are right. I am willing to accept the post money valuation of 4 million. He will be giving away 25% of the company in this round, which is 1 divided by 4, which is the current raise divided by the post money. You never look at the percentage of the company given away with pre-money. You always say, what am I raising divided by post money?
And what was, for this example, I've sort of lost, what was the unknown, like in purpose of doing this calculation?
I'm sorry, I don't get the question. What do you mean?
So going like, I guess in this example, why did we start with projected revenue to work back to the post money? Because a lot of founders that are raising will give you the pre-money and what they're looking to raise is known. So you can just add those to get to the post money. I lost track of why we were doing this calculation.
Right.
This
No,
way.
so this is just another way for calculating the valuation of the company. So the founder is going to come and say, my valuation, I think my company is worth 10 million. And I'm like, oh, great, let me do my calculation. So as a VC, as an investor, and especially at Series A, that's when the VCs come in most of the time and beyond, we have some revenue projections, right? And we have data that says in year 5, I'm going to make this. So these are, all I'm saying with this 3-4 method is that there are different ways of looking at it depending on what where you are in the journey at which stage and which is your preferred method. Let me tell you this, the VC way is the preferred method for all investors. Very few investors look at the dilution method. Dilution method is a preferred method for founders to understand what can be my company worth, right?
So even at the angel level, people are looking at the VC method.
People are looking at the VC method, if there is a revenue and revenue forecast. And as you know, early stage companies are very sophisticated. They are able to prove that they have the business model, much earlier than, when I started investing in 2012, 2013. Was that helpful, Jennifer? So in your case, your private equity guys are coming and saying, great, we think you say I'm going to make $40 million revenue. And they think that, okay, you haven't closed all this contract, so we're going to cut it in half.
Or cut
Right?
a portion off, yeah.
Yeah, or to cut a portion of whatever it is, right? So now you are in charge and saying that, is that really fair based on my past performance? Right?
Yeah.
Okay. Well, now we all are invested in your well-being, so please keep us posted. You don't have to share details, but we just want you
No,
to
I
get what you
will, I
deserve.
will, I will, I will.
So, Jags, question on that, because I've seen in terms of the potential, like the probability of founders reaching the said revenue numbers in 5 years' time, how much do you change the weighting of that in your mind based upon how long they've been operating? So Jennifer's company is in a unique situation because it's been around for a long time. So there's theoretically or arguably a bit more certainty on the ability to execute. How would you do anything differently if this was a company that's been around for 1 year, for example? Should we be discounting revenue more?
Well, so that's a great question, and it depends is my answer, right? Let's see what kind of data do I see. Remember, past performance is a great indication of future promises, right?
You should go work for an asset management company.
Well,
Sorry, I digress.
Yeah.
Go on.
No. So if I look at the cash flow statement and the financial statement, and I see that, he consistently says that he's going to do this, and he is not able to, or she's not able to, Miss Founder, then I am going to have more doubt. If they say we feel confident that because we have done this and we met our goals year over year, month over month, we feel confident about that. Also look at their assets, their liabilities. How are they spending money? How much are they paying in salaries? What is their burn rate? Burn rate is $55,000. What does that include? Are they putting $40,000 in marketing to acquire $10,000 worth of customers? All that comes in play in order for you to make a decision. Should I, cut the revenue in half? Should I leave it there? Or should I, but so I hope that answered your question, that it depends, but all these things that we built up to it, to this point, is important. The past session on financial statement is important.
Okay. And so sorry, I have to drop for my 1 o'clock. Will you, you'll be posting the slides for the valuation methods at some point?
Yes, absolutely.
Okay, we'll go for later
or
in the
we
week.
can
Okay.
even, we will do another session or something. Thank you for coming.
Okay, look forward to seeing
All
everyone soon. Bye.
Thanks, bye. The last method is the market oriented. So that is what's happening in the market. So the greatest example right now is that I can give you is Clubhouse, right? You are all familiar with Clubhouse app. they raised money and now they're at a $1 billion valuation. Mind blowing, mind blowing. They're still, very, 2-year-old company, not even 2 year, 1 year, maybe. I don't even know the date they founded. So we all thought that social media companies were probably, a thing of a past, but it may be not so fast. I'm not seeing, okay, there you go. So if another company right now comes and it's a hard company, let's say Clubhouse approached me when they were first, raising money, and they say this is what we are doing. I would not have much say into, okay, this is my desired valuation. That's called a party round. Remember, we talked about that. What is happening in the market, and the founder has a complete, authority of whatever they want to ask, the valuation that they want to ask. So if a company like that comes along, they're very, very rarely I invest in companies like that. Very, very rarely. Like I gave you an example of Girlfriend Collective, right? They came to me, Girlfriends Collective, and I'm like, okay, this doesn't fit my thesis. And also, does a world need another, activewear company? What I failed to do was a little bit of due diligence, because they were taking plastic recycling bottles and making this outfit. In my mind, it was like, is this something, what is the acquisition that are happening in this field? This is a crowded market, et cetera, and I would not pay $70 for a new brand versus Lululemon or whatever, right? So obviously I missed out on that. But having said that, if I had done my due diligence, and if I really had looked at the company and their model, I probably would have said, okay, you said $30 million valuation. I really believe that is something that can happen, and you have the right team, et cetera, and I would go and invest. So basically, the market oriented is literally like picking the number out of the air and say, am I fully convicted behind this company? Do I have the deep conviction behind this company? And does the market show me that there is an opportunity for companies like this to exist? Especially true when you are looking at a company in a very crowded market, like Clubhouse in a world of social media, and Girlfriends Collective in a world of a lot of activewear by very brand name companies. But the model that they have is just incredible, and they're doing superb. Another company that comes to mind is, I did not invest in this company, but I know somebody else did, is the company Madison Reed, which is the hair color company, right? Actually, it's my friend's friend, and they came, they said we are raising, and by the time I could get to it, they had closed their round. Another company, does the market demand organic, not organic, I don't know, good for you hair color, right? And I definitely would have jumped on that, because I definitely need that service. And I now pay $60 a month subscription just to cover my gray hair. I think it's brilliant. So that's what I mean by, and they had the term sheet. They went out and said, this is the term sheet we are raising on, in or out. No negotiation, right? Same thing with Hair Alone, which we raised the syndicate, and they said, this is the valuation, in or out. So those are the companies that are literally, is this the company that is going to be more than $100 million in revenue? That's the question you want to ask when you are looking at the market. Any questions? Jennifer, I think you said something, but you're muted. I wasn't sure. I can only.
No, I was just agreeing and listening to that story, and just the Madison Reed is a really good example,
Yeah.
because she believed in herself so much. I could see her just saying, take it or leave it,
Yeah. Yeah.
This is what I say. It's worth.
Yeah. So those are the 4 models. I think I apologize again for not having slides, but you will have slides. And I think it was actually good today that we actually had a conversation, because I feel a lot of times I'm just talking at you guys, and I really want to know what you're thinking, and we're trying to get through the slides. So whatever happens for the best, I guess.
It does. Thanks for putting up all the links. Now I'm going to go read them all.
Oh, what links
There's just like
do I?
an article
Oh,
in the
maybe
chat.
Kate
Yeah.
did that. I am on my
Well,
phone, so
yeah,
I can't
I
see
just put up a
anything.
few links.
Thank
There's
you,
one,
Joan.
there's a female angel that I've been following, and she's actually posted her spreadsheets redacted. But it's interesting. They're not as clean as I would like, or readable, but at least you start with something, right? You at least see someone else's examples, and she's beautiful Medium post write-ups.
Can you send me those links by an email, Joan, if that's okay?
Yeah, sure thing.
Since I'm on my phone and
they're publicly available. I'm not like, sharing someone's secret sauce that's not,
oh no, so the all this information is available, right? I mean, I'm not saying, and I learned it like this too, but it helps when somebody says, okay, read this, because there are like million things. So if somebody says, out of million, read this link, it means a lot to me that you are, you recommend this. So I appreciate it.
Sure thing. I find it super helpful.
Hey, Jennifer, I'm going to be in LA next weekend. I'm bringing my daughter in. I would love to, have a social distance coffee if you're up for it.
I'm double vaccinated.
Me double vaccinated, meaning 2 shots.
Yeah.
Congratulations.
Thank you. Yeah, I would love that. Yeah, just get in touch. I would love that. I'm around. I'm here.
Okay, sounds good. I'll be there from 23rd, the day after, till 28th. So we're looking for an apartment for her. She's starting work there.
I can also talk to you about neighborhoods and stuff like that.
Oh, we'd love that. All right, sounds good.
Okay.
Good luck in your negotiations, Jennifer.
Thank you so much.
Yeah.
It's just been a unexpected past few days. That means a lot thank you for your encouragement, everyone's encouragement. Stand tough.
Stand in your power.
You are not alone. You are not alone at all. You got this.
I'm trying. Somebody sent me a GIF of like Daenerys, like with all of the dragon thing. And I'm like, until her lover killed her at the end, so I don't know if that was the best thing to send me.
That was written by white men about women.
So this is much better support. Thank you guys.
Yeah, and reach out, if you just want some, because I think, out of all of us, you are probably in a space right now where what we are talking about is most relevant. And I'm not saying it's not relevant for others, but like your heart and soul and sweat and tears and whatever you put into this company, don't give it away.
Well, I've said like, I don't have any intention of negotiating, but if they come back and say, well, it's going to be over unless you do this, then I would love to like reach out maybe to see what you guys think of that. So.
Do you have a mentor? Do you have a mentor?
I do. And he's the one who told me just to stand ground, because 4 months ago, he was like, you're not even ready to sell. They approached you. They want to push you to sell faster. So you have all the power, and now they're trying to take it away.
Yeah. Let me tell you a story, Jennifer. And I'll tell you this because I want you to think about this. And I'm not saying this is what's happening. So one of the company I invested in is called Deep Effects, right? So I not only invested a lot of money, I believed in the company. It's a voice AI company. And I actually helped them create their customer success platforms. I was more than just an investor, right? Last year in January 2020, one of the a private company in the same space tried to acquire them and went through. He wasn't even looking for the acquisition, right? He was just going to grow his company. But he got excited because like, oh, somebody's interested in my company. March 15th, they pulled out because COVID happened and all the lockdowns happened. After doing 2.5 months of due diligence and thought similar situation, we were on the last mile, signing paperwork, every last bit of tech due diligence, everything was done. They pulled out. Now the founder, single founder, solo founder, I know him well, went into this thing that I have to sell my company. I have to sell my company because I don't know what's happening. I'm scared, right? And he had the most amazing technology. No matter who told him, he had mentors. I told him, no, you don't. You have a pipeline, whatever. He ended up selling the company for half the price, half the valuation to Ring Central. End of this in January, exactly a year later in 2021. What happened was that his mind shifted. His mind shifted from he wasn't even looking for somebody to acquire him to somebody showing really good interest in saying that we'll pay you this much, which was, I thought it was still below what his technology could do. Got excited, went through all the due diligence, solo founder, had a team of 10 and became really, his mind shifted. And I'm not saying that that's going to happen to you, but I want to share this because I want you to know that what happened, it was very common. And then he went into this thing, his dad got cancer, stage 4 cancer, and he just became desperate to sell and he sold the company.
Well, it shakes your confidence, and it sounds like his
It does.
confidence got shaken a little bit.
Yeah. So
I'm
don't
trying
let that
not
happen.
to let that happen.
Yeah. And I'm not comparing by any means.
I know.
So-
I know it's all relevant. It's all relevant.
and he had an amazing technology, and I believe your company has an amazing product, service, whatever it is that you are doing. So stand in your power and know that there are plenty of people out there for a good acquisition. And they will come back to you. So this is the game they're going to play. You're going to say, no, I'm not selling unless I get this. They're going to come back to you and say, okay, last chance. If you don't do this, that's it. We are moving on. You, at that point, going to go back inward and ask yourself this question: am I okay with it now? And am I okay with it 10 years from now?
Yeah.
And if the answer to both of that is yes, do what your heart says. And if the answer is, yeah, I'll be okay, and not, then do according to that. There is no wrong answer, but
Right.
go inward to find that.
Yeah, and
That
Jennifer,
would
if I
be my
can,
advice.
I know I'm a few career steps behind you in some respects, but I actually mentor multiple mentees in salary negotiations at that table, and the kind of the tactics that are used, especially, or like I can even talk about, I got an offer from Facebook AI a few chapters ago. Really cool offer, phenomenal. Like there was a reason, and how many months you get to that point, right? And then some of the tactics that are used to, you're not actually that valuable, or these things. I was like, wait a minute, they spent how much in recruiting me, right? They spent how much in all these other things. They have a place for me on the team. They know I'm valuable. I can't tell you much, it's under NDA, but I was extremely unique in the skill set that I could bring to them, similar to the unique thing that they want to integrate. It sounds like that they don't have necessarily a lot of options. Like to me, it sounds like a very calculated power play. And I would strongly recommend having a huge brag sheet. I don't know if you have one of those today, but that's one of the things I use in my tactical negotiations of, like, you want me, I'm confident I can bring value. I have a PhD, I have 8 years of direct experience. I've already worked with several companies that are or this is my own brag sheet. I don't know what yours is, but to really build yourself up. And this is why you want to move forward in this way. It sounds like in that, the numbers power play in that room, I don't know if you can bring in an associate or someone who can also be on your side.
He did it so sneaky. We always have these meetings with like 6 people, and he's like, oh, let's just have this meeting one-on-one. And then he pulled this shit on me. Like, I felt very vulnerable. It was so badly handled.
Yeah, and also you don't want to, you can just say thank you for your generosity. I understand the point of the place you're coming from, but remember that I have a lot to add, and this company is going to multiply your value as well. So unless you're serious about acquisition at the right price, let's hold off on this.
Can you say that again? It multiplies. It actually multiplies not only my value, but their own value, because they're missing what I have.
Yeah.
multiplies
So-
their value as well as just my value. So looking at just my revenue, it's more than that.
Oh yeah, it's more, it's intangibly a lot more than tangible. Because they can add this to your portfolio, whatever it is that you're saying that they're missing. So the
They
intrinsic
approached
value is
you.
a
They
huge.
approached you.
I
Yeah,
know.
I really.
They're
Yeah.
like, we need to reinvigorate our company. We're missing this whole piece, which makes our piece that we have now not so valuable or not so interesting to the market. And all the things.
Yeah.
And so that's why it just feels like such a manipulated thing.
Don't let them get in your head.
I'm
don't let them-
sorry if I hijacked this morning.
No,
I
not
don't
at
like
all,
to do
Jennifer.
that.
I mean, I'm speaking for everybody, sorry, but I love this conversation. And, my goal is not just to like spend 2 hours with you and go. We have to stand together as a community of women because these things are real. The power plays are real. It doesn't matter how many statistics say women are, moving forward and, no, this is the core of this community, is to be there for each other and propel each other, elevate each other. So Jennifer, I would say just remind them, remember, these are your words I'm using. You obviously think that I am going to bring a lot of value. So unless you're seriously considering acquiring me for not only the current value, but also the future value, let's hold off. And I'm happy to connect with you in future, whatever, when you guys have sorted your thing out.
I am also going to make that brag sheet, Joan, that even if I don't use it, it'll make me feel
Yeah.
like a
It's
tool
a powerful tool. It really is. I have X years of experience. Look at all these contracts signed. I have these relationships. And as Jag mentioned, even if you're 90% to closing some of these deals, you have all those relationships, which is the reason why Nuance or Microsoft just acquired Nuance, not for the tech, for their huge Rolodex, right? There's some
Yeah.
intangible things that are so powerful.
Yeah.
What I really hear also, I don't know if anyone's read Brené Brown, but she has the Dare to Lead book.
Oh, I
And there's
love that.
oh my God, I like highlight
it's
and
right
ear
here,
note.
somewhere here.
She's such a fucking badass. And she's a female researcher, which again, but she talks about one of the things that people are, when they are most vulnerable, is the thing that they are most critical of others about. There's a lot of research about this. And so what I even hear is he is nervous about hitting his quotas internally. And so trying to get a good deal off of you by potentially
make
trying
him
to
look
shame
good.
you. Right.
And remember also mirroring neurons, right? As human beings, we mirror each other. If he is putting this thing, scarcity, or like you're going to lose out, we are absorbing that and we are mirroring that in our mind and saying, maybe he is right. So knowing that, you will say, stand back.
Well, I'm glad you guys think this is good for everything. I was even thinking of, Beth, at your stage in your career, I researched your company. My CISO knows your company. He's like, it's amazing. It's amazing. So like after being at your company for X number of years, you have so much value.
Oh wait, Cloudflare.
Yeah.
Oh yeah, I'm in
Other-
our Q2 kickoff is over there.
So it's like, you're going to have a big brag sheet. I didn't realize how big of a company that was that you worked for.
Yeah, I was thinking because I get recruited by different companies and I really want to move into like health tech. So I get recruited by companies and I'm like, oh, I'd also like to invest in you. Like the newest ones they use like these diabetic monitors to like measure blood sugar, but they're like using that for just generic people health apps. And I think that's like fascinating. So you see these companies, I like to work with you and I would also like to invest in you. And so stuff like that's really, I like
Well,
Cloudflare.
I think this is a great idea. We all should have create a brag sheet as a homework. Whether you share it or not, up to you. But just take some time this weekend, and let's create a brag sheet. Why not?
Okay.
There's a
Thank you,
lot of
guys.
smart, awesome, brilliant, talented people in this room. I'm guessing those brag sheets are very long.
Yeah, and I have made so many mistakes in my career, and I always put myself behind everybody else. As a single mom, I thought I was, it just was really. It's actually 2 years ago when my mom passed away when she was 53, and it hit me 2 years ago. It's like, oh shit, I'm going to be 53 in 2 years. What if that happens to me? I want to do so much. And that was like a push for me, right? And I'm 54 now, so I passed that. Yeah. So what I'm saying is that I had people also telling me exactly this when I needed to hear this. And who knows, I might be in the same situation in future. So let's be there for each other. I hope today's session was useful in more than one ways, and wish you the best, Jennifer. And thank you for accommodating my computer crash.
Thank you.
Absolutely.
All right, guys, ladies.
Great day.
Cheers, everyone.
Thank
Good
you.
luck, Jennifer.
Bye.
Good luck, Jennifer.
Bye. Thank you, Jags.
Thanks.
Thank
Bye.
you so much. Thanks, Jax.
Thank you. Bye, guys.